Standard costing is a widely adopted cost accounting technique that has long been the foundation of cost management for manufacturing organizations. By establishing predetermined cost standards for direct materials, direct labor, and manufacturing overhead, companies can track variances from these standards to identify opportunities for cost reduction and process improvement. However, the applicability of standard costing to service-based businesses has been increasingly called into question. The unique characteristics of service industries, such as intangibility, heterogeneity, and the central role of human labor, pose significant challenges to the effective implementation of standard costing practices. In this article, we will explore why standard costing often fails to deliver the same benefits in service industries as it does in manufacturing, and examine alternative approaches that may be better suited to the needs of service-based organizations. The limitations of standard costing in service environments, intangibility and heterogeneity of services. One of the fundamental differences between manufacturing and service industries is the nature of the output. Manufactured goods are tangible, standardized products that can be easily quantified and priced. In contrast, services are intangible and often highly customized to meet the specific needs of each customer. This makes it challenging to establish reliable cost standards for service activities. In a manufacturing setting, the cost of producing a single unit of a product can be accurately determined based on the fixed and variable costs associated with the production process. However, in a service environment, the cost of delivering a particular service can vary significantly depending on factors such as the complexity of the task, the expertise required, the time spent, and the resources utilized. This level of variability makes it difficult to develop accurate standard costs that can be consistently applied across all service engagements. Difficulty in measuring and allocating indirect costs. Another key challenge in applying standard costing to service industries is the difficulty in accurately measuring and allocating indirect costs. In manufacturing, indirect costs, such as factory overhead and administrative expenses, can be more easily traced to specific products or production lines. This allows for a more straightforward application of standard costing techniques. In service organizations, however, indirect costs are often more diffuse and harder to attribute to individual service offerings. The nature of service work, which typically involves a high degree of human labor and intellectual effort, makes it challenging to determine the appropriate allocation of indirect costs. This can lead to distortions in the reported costs of individual services, undermining the reliability of standard costing information. The central role of human labor. A defining characteristic of service industries is the central role of human labor in the delivery of services. Unlike manufacturing, where much of the work is performed by machines and automation, service organizations rely heavily on the skills, knowledge, and expertise of their employees to create value for customers. This heavy reliance on human labor introduces a high degree of variability and subjectivity into the cost structure of service businesses. The time and effort required to complete a particular service task can be influenced by factors such as the individual employee's experience, training, and level of expertise. This makes it challenging to establish reliable standard costs that accurately reflect the true cost of delivering a service. Furthermore, the ability to accurately measure and control the labor costs associated with service delivery is often hampered by the difficulty in quantifying and standardizing the work performed by knowledge workers. The cognitive and interpersonal skills required in many service roles are inherently difficult to standardize, further undermining the effectiveness of standard costing approaches. Changing customer expectations and demand volatility. Service industries often operate in dynamic, rapidly changing environments where customer expectations and demand patterns can fluctuate significantly. This volatility can make it difficult to establish and maintain accurate standard costs over time. As customer preferences and service requirements evolve, the underlying cost structure of service organizations may need to be continuously adjusted to keep pace. However, the rigid nature of standard costing, with its emphasis on predetermined cost standards, can make it challenging for service businesses to respond quickly to these market changes. Moreover, the unpredictable nature of service demand can lead to significant fluctuations in resource utilization, further complicating the application of standard costing. Periods of high demand may require the mobilization of additional resources, while periods of low demand may result in excess capacity, both of which can distort the accuracy of standard cost information. Alternative approaches for cost tracking in service-based businesses. Given the limitations of standard costing in service environments, service-based organizations have explored alternative approaches to cost management that better align with the unique characteristics of their industries. Some of these alternative methods include activity-based costing. Activity-based costing, ABC, is a more sophisticated cost accounting methodology that focuses on the identification and allocation of costs based on the activities and processes required to deliver a service. By tracing costs to specific activities, rather than relying on broad overhead allocation, ABC can provide a more accurate picture of the true cost drivers within a service organization. ABC is particularly well suited to service industries, as it allows for the capture of the complexities and variability inherent in service delivery. This approach can help service organizations better understand the cost implications of factors such as employee skill levels, resource utilization, and the level of customization required for each service engagement. Lean accounting. Lean accounting is a management accounting approach that aligns with the principles of lean manufacturing, emphasizing the elimination of waste and the optimization of value-added activities. In a service context, lean accounting focuses on identifying and reducing non-value-added activities, streamlining processes, and improving the flow of work. By shifting the emphasis from traditional cost-based metrics to more holistic measures of business performance, such as customer satisfaction, employee engagement, and process efficiency, lean accounting can provide service organizations with a more comprehensive and actionable understanding of their cost structure and profitability. Throughput accounting. Throughput accounting, also known as the theory of constraints, TOC, is an approach that focuses on identifying and managing the constraints or bottlenecks within a system that limit its overall throughput. In service industries, this can involve identifying the critical resources or processes that most significantly impact the delivery of services and optimizing them to maximize the flow of work. Throughput accounting emphasizes the importance of understanding the relationship between revenue, operational expenses, and the utilization of scarce resources. This perspective can be particularly valuable for service organizations, where the efficient management of human capital and other limited resources is crucial to maintaining profitability. Rolling forecasts and agile budgeting. Traditional budgeting and forecasting processes, which often rely on static annual plans, may not be well suited to the dynamic nature of service industries. Service organizations are increasingly adopting more agile and responsive approaches, such as rolling forecasts and continuous budgeting, to better align with changing market conditions and customer demands. Rolling forecasts, which are updated on a more frequent basis, e.g., monthly or quarterly, can provide service businesses with a more accurate and timely understanding of their financial performance and cost structure. This allows them to quickly identify and address variances, as well as to make informed decisions about resource allocation and pricing strategies. Similarly, agile budgeting approaches, which emphasize flexibility and frequent adjustments, can help service organizations adapt their cost structures and budgets in response to evolving market conditions and customer needs. Balanced scorecard and key performance indicators, KPIs. To move beyond the limitations of traditional cost-based metrics, many service organizations have embraced the balanced scorecard approach, which incorporates a broader range of financial and non-financial performance indicators. This framework encourages service businesses to track and measure factors such as customer satisfaction, employee engagement, process efficiency, and innovation, in addition to traditional financial metrics. By aligning these key performance indicators, KPIs, with the organization's strategic objectives, service companies can gain a more holistic understanding of their performance and make more informed decisions about cost management and resource allocation. Conclusion: the unique characteristics of service industries, such as intangibility, heterogeneity, and the central role of human labor, pose significant challenges to the effective implementation of standard costing practices. As a result, service-based organizations have increasingly explored alternative approaches to cost management that better align with the needs of their industry. Techniques such as activity-based costing, lean accounting, throughput accounting, rolling forecasts, and the balanced scorecard offer service businesses more flexible and responsive frameworks for understanding and managing their cost structures. By embracing these alternative methods, service organizations can gain deeper insights into their operations, make more informed decisions, and ultimately improve their overall financial performance and competitiveness. As the service economy continues to grow and evolve, the need for innovative cost management strategies will only become more pressing. By recognizing the limitations of standard costing in service environments and adopting more tailored approaches, service-based businesses can position themselves for long-term success in an increasingly dynamic and competitive marketplace.